Welcome. Thanks for joining us here on Market Call. I'm Morella Fernandez. Martin Cobb with us on the show today. He's Senior Vice President Equities at Lorne Steinberg Wealth Management. He'll take your questions on U.S. and Canadian equities. Here's how to reach us. Toll free, 1-855-326-6266. You could also email your questions, marketcall@bnnbloomberg.ca. Martin, good to see you. Thanks for coming in.
Hi, Morella.
So positive days so far on the markets. We had the TSX, which has been hitting routine highs. We had the NASDAQ 100 pop through one of its records. But you think there could be some lackluster returns ahead. Why do you say that?
We've talked previously about absolute valuation metrics, price earnings, long-term price earnings, like the cyclically adjusted price earnings ratio. Another one I came across this week is just looking at the equity risk premium, which compares the earnings yield on the S&P 500 with the bond yields. Now, the bond yields are a little bit lower in the past 3 or 4 weeks, but ultimately we're at zero. Effectively, equities are yielding as much as bonds. And historically, you look back over the last 3 decades, my career, that has been a harbinger of typically fairly pedestrian returns over the next 12 months. So, again, it's another valuation metric. We can debate about the economy, we can debate about tariffs, but the starting point of valuations for equities, particularly south of the border, is expensive.
And is there a timeline that you typically associate with this?
That's a 12-month horizon.
That's a 12-month.
Just mining the data. And to be honest, 12 months stock market outlooks are flip of a coin typically. I'm just telling you historically, given where we are versus bonds and in absolute terms, 12-month returns have not been particularly good from this point.
Are there usually or typically exceptions to that rule? And I ask because tech has still been on a tear, come back from the April low. NVIDIA has been sort of breaking through highs yesterday. So are there always sort of exceptions to that general rule?
Absolutely, and valuations are a terrible indicator of short-term returns. They're a very good indicator of long-term returns, but not a very good indicator of short-term returns. In the short term, the market is a popularity contest, and that popularity contest can go on for a very long time. If you go back to the technology and media and telecoms bubble in the 1990s, Greenspan talked about irrational exuberance in 1996, and the market didn't peak till almost 2000.
Okay, so I also want to ask you what you expect for the latter half of this year, because we've talked a little bit about tariffs sort of working through the economies. Now everybody's sort of pulling back on their outlook as far as the weakness goes. There'll be weakness, but it won't be sort of as bad as first expected. So what are your thoughts for the latter half of the year?
It's interesting. I mean, we are less than 2 weeks away from the 9th of July, which is the 90-day reprieve from, Liberation Day, from the 2nd of April. Who knows what will happen then? There's obviously furious discussions taking place. How you strike trade deals within 2 weeks, I have no idea. There's going to be continued, I think, noise, friction within the whole system. We're just seeing things slowing down. So I'm never a huge one for pointing to what the economy is going to do to then predicting stock markets. It doesn't work that way. Typically, it's the other way around. But here we are back at pretty much where we started the year in terms of the S&P. The TSX up nicely. A lot of good news starts to feel like it's been baked in, so perhaps we might just pause for breath.
Yeah, the bad news might also be baked in. I don't think people are reactive as they were at the start of the year, right? So the July 9th, whatever comes down, do you expect a big reaction?
I think I mentioned last time, talking about sort of just tariff fatigue, that we get to the point where we stop worrying about it. The initial reactions are very, very spiky in terms of stock market moves, but we're so used to this now. We just want to get on with our lives and deal with it. Yes, there will be individual businesses, particularly, here in Ontario, trading with south of the border, that will be impacted. But investors tend to look longer term. And at some point, we will come through this and we'll get on with our lives.
Got it. All right, Martin Cobb with us today from Lorne Steinberg Wealth Management. He's taking your questions on U.S. and Canadian equities. Here's how to reach us. We're back in a moment. Welcome back. Thanks for joining us here on Market Call. We are going right to an email from Jerry. He says, thoughts on TRRI on the Toronto Exchange. We will turn that over to Martin and get his take. Martin.
Yes, TRRI or Thomson Reuters reminds me of when I started my career at Baillie Gifford. One of my first jobs as an investment analyst was cutting up faxes and also looking at the back pages of Financial Times for share prices. That's how we got our share prices back in the day. And then a Reuters terminal...
You're dating yourself. Yes, you are.
I know I am. A Reuters terminal appeared at the end of the desk. Suddenly we had information, we had share prices. And so Reuters has just been a news agency. is probably best known for, but a data provider over the last 30 years that I've been working in this industry. Although today it's much more legal, tax, accounting, mission-critical information provided to those professions. It's not a stellar grower. I mean, it doesn't really have huge top-line growth, but very strong recurring revenues. You simply need your Thomson Reuters products providing you with that information to do your business in those various professions. The problem I have with it is it just always looks very expensive. I mean, today the price earnings multiples are around about 50 times. Now, that is not out of whack with its history, but it just seems out of whack in an absolute terms. So, like the business, may well be around for another 100 years or so, which I think Reuters has been around for. But ultimately, you're buying on a 2% earnings yield. We were talking about yields earlier. You can get twice that in bonds and twice that in the market. So I'm not sure I'd pay up for that. That feels a little bit, risk reward not particularly attractive.
And not necessarily a lot of growth?
No, not top line. I mean, they've been very good in capital discipline. They had a Refinitiv business, which they sold to the London Stock Exchange. They've been buying back shares. So the bottom line growth is a little bit better, but it's not stellar, and not for that multiple. You would expect paying 50 times for a business. You would expect good, I would say earnings per share growth in the teens or even the 20s, and it's not even close to that.
Got it. Okay, let's go to the phone lines. John's on the line from London, Ontario. Hi, John.
Thanks, Marilla. Hello, Martin.
Hello.
My question's on Palantir. I'm in at 17. I added just shy of 70, and I've been trying to add again. Profit is growing briskly, so is revenue. Reminds me of Eric Liddell running in Paris 101 years ago, running the quarter. Is now the time to add? You did mention the harbinger of the two rates that you mentioned. But I'd really like to add to Palantir because I think it's real. Thanks very much.
Okay, thanks for the questions at 144.67 today.
I'm going to struggle to agree with adding to it here. I think the first thing you should do in terms of investing, now there's tax obviously implications, but forget what you paid for something. That's anchoring to the past. And one of the best things you can do in our industry is forget what you paid. If you made a mistake, you need to move on. So I tend to ignore book costs, but he's obviously done very well buying it back then. So congratulations to you. I love the products. I mean, what Palantir does for the defence industry is spooky. I mean, spookily clever. And now they're bringing that to the corporate sector in terms of using AI tools to help businesses understand their data, etc. So love what they do. But last I looked, it was on 200 times earnings. So yes, the growth rate is there, but you've got to believe that growth rate continues for 10 or 20 years. There's no competition, no margins, no slowdown, etc. So I would be on the other tack. If you served yourself very well with buying it at those levels, I'd be mindful of your position size, given the valuation. You look back in stock markets, these great businesses can compress their multiple quite easily without the news even getting bad.
Okay, so would you just take a little off the top and keep in at this point? Is that kind of the direction?
I would take more than a little off the top.
More than a little off the top.
Sorry to answer the question
no,
that's
fine. That's fine. Thanks for that. Let's move on to Brian, who's calling from Trenton, Ontario. Hi, Brian.
Hi, good morning, Marilla. Thank you for taking my call. I'm phoning again on a question I posed even a couple of years ago to Andy, who was the host before you, and the other gentleman who's terrific. I asked him too. My investment club has asked it, but frankly, the last time I called in, you said that you lost my call on the phone, which wasn't true.
What's your question, Brian? Okay. It looks like you had a question about Walmart. Costco, Walmart have been doing very, very well, especially with the climate being concerns about the economy.
Yeah, it's hard not to like Walmart as a business, or Costco as a business, certainly. They've done a great job on the e-commerce side. They were laggards for there, and they really had to invest to play catch-up because Amazon and co were kind of eating their lunch. But they're now offering this lovely hybrid model where you can go to the Walmart store, buy anything you possibly can, or you can go online and do the same thing, and very price competitive, kind of everyday low prices. So I think they're very well positioned, structurally for the long term. Obviously, big debate, massive importer of goods. So, they will have to, wear the tariffs. Well, actually, customers will actually have to wear the tariffs ultimately. So there are some pressures on the business. But I like the position. There's still got some good international growth opportunities. I don't get too excited about that, but it will give a little bit additional growth. The valuation isn't cheap, but, Walmart never cheap. Costco's never cheap. These are great businesses. I tend to have these in the portfolio and forget about them.
Okay, because Walmart has said it will need to pass some of those costs on to the consumer, but I guess consumers don't have other places necessarily to go besides Amazon.
Yes, exactly. So and if you're going to buy groceries, because groceries are a big part of Walmart as well. It's not just the hard goods. So if your groceries, they're very competitive there. They will have to pass those prices on. Those will be less affected by tariffs. Some of the goods obviously bought here in Canada or in the US are bought domestically, but ultimately customers will have to wear those costs. I think last time out, when we looked at the tariffs that came with the first time presidency of Donald Trump, about 75% was passed through, about 25% was absorbed. This time may well be the same.
Got it. Okay, we are going to take a quick break, lining up more phone calls and emails for Martin. We're back in a moment. Welcome back, and thanks very much for joining us on Market Call. We're going straight to an email question we have for Martin. Let's go to that question board if we have it up. If not, we'll go back to the callers. There we go. Robert, what are your thoughts on Definity? It has had a great run. Time to take some profits is the question. Definity is insurance?
Yes, property and casualty insurance. So think home insurance and car insurance. It was demutualised. So it was owned by its policyholders, so demutualised in 2021. I come from the land, the UK, of lots of demutualisations, and they typically could have gone one of two ways. The companies remain pretty sleepy. It can never kind of throw off the shackles of being a mutual non-for-profit type business. Or they can be energised and have focus and efficiency, et cetera, and growth. And Definity is definitely in the latter camp. So they've done a great job of driving growth and driving efficiencies. They're looking to buy Travelers Canada, so that will make them the fourth largest here in Canada, which gives them some good scale. So tick all the boxes in terms of how the business is done. In terms of taking profit, I kind of have to agree. I mean, the target management have for Definity is to make a 12% return on equity, which isn't huge, but isn't bad by their industry standards. What would you typically pay for that? 1.5, 1.6 times book value? Today, they're trading on 2.4 times book value, a big premium to Intact, which is the market leader here in terms of independence. So I would say, yes, watch your position size, take some profits. It served you well, well-run business, but pricing in a lot of continued growth.
Got it. Okay, let's go to the phone lines. Greg is on the line with the question today. Hi, Greg.
Yeah, hi, and thank you for taking my call. My question is about Marvell Technologies. They reported back in February, had very good numbers, but had a tremendous slide. But in the last month, they've been coming back pretty strong, and today they're up a significant amount. I'd like to know if you currently hold Marvell Technologies, and if you think this is at a good point to buy another swath of it. Thank you very much, and I'll look forward to your answer.
Martin, is that dive there the same April dive we've seen for everything else, and it's come back?
Yeah.
We just moved off of it,
yes,
sorry. We'll go back if we can. So Marvell's at 80.82 at this point, and there's the 1 year, so you see that creep down. But the creep down started sort of much earlier than April.
Yeah. I mean, Marvell is just... We don't own it, so be clear about that. And the reason we don't own it is because of the cyclicality of the industry. They're a leader, still are in hard disk drives, etc. So IT hardware, it's just a more commoditized type market. So we've tended to focus on those companies that have an economic moat. We own TSMC, for example. We are considering ASML in the Netherlands. Just those companies where there is a less commoditized product. So Marvell, if you get your cycle right, you get a kind of hard, soft market, get your timing right, you can do very well. But we just don't like the cyclicality of that end of the IT hardware market.
Got it. Okay, let's move on then to caller Mitch from Calgary. Hi, Mitch.
Hey there. Yeah, I was wondering about Dollarama. It's done quite well the last couple of years, but I wanted to know what price you like it at, and also if you have any insight into any increases in dividends in the near future, if they plan to make any increases to that. Thanks for taking my call.
Thanks for the question. We'll pull up Dollarama and have a look at the chart as well. These are, again, businesses on this end of retail have done very, very well. Dollarama sitting at 190, almost 191 today, even though it's down a little on the day.
Dollarama was a stock we bought when we launched our Canadian dividend growth strategy in early 2020. And I think it's probably the best performing stock we've held since then. Doesn't pay a great dividend. That's never really been its ken. It doesn't really want to pay a great dividend. It will grow the dividend to some extent, but it's focused more on inorganic growth and share buybacks. Nothing to complain about in terms of the business. I mean, they are almost Amazon-proof. Their scale has given them buying power. They have a lot of own label. So they've been growing the top line, here in Canada, close to 10%. A little bit margin improvement. They bought Dollar City down in Latin America. Now they've bought in Australia. So they're pursuing an inorganic strategy as well. The problem I have with I sound a bit like a broken record. The problem I have with it is just valuation. Today, trading at over 40 times next year's earnings. Great business, but a little bit priced for perfection. So we still like it, we still own it, but it is one that we were looking to trim to some extent. Again, it's not because anything might go wrong with the business, but that valuation multiple could historically compare to something like 25 times. So we're trading quite a premium to that. Some of that's deserved. Some that feels a little bit excessive. Why
is it Amazon-proof? What about it makes it Amazon-proof? Because you're right, a lot of people could go on Amazon and get similar products at a reasonable price.
A lot is own label, but the most important thing, think if you walk into Best Buy, you see the television on the wall that you like, you're on your phone, you compare it to Amazon, you can see something. You walk into Dollarama and you see your $3, toilet brush. You don't go into Amazon effectively to try and trade.
You don't really care.
You don't really
it's
care.
40 cents, 25 cents.
Exactly. The price point is $5 maximum they have. Their goods are, I say, about 50% now private label. They're very price competitive. They are as cheap, if not cheaper than Amazon in a lot of cases. So it's just not, something to worry about. Great business. Just worry a little bit about the valuation.
Got it. All right, Mitch, I hope that helps you out. Let's go on to Pat, who's calling from Mississauga, Ontario. Hi, Pat.
Hi there, folks. Thank you for taking my call. I'm calling you about NVIDIA. Own quite a large holding or position in it. I'm just concerned about the valuation, whether I should hold on to it a bit longer or take some profits. What are your thoughts?
Okay, so NVIDIA, I'm sure you'd be happy if you've been holding on to NVIDIA. It's done pretty well the past 24 hours, 48 hours, up to 155.57 at this point. Are you on the bandwagon with everybody else? NVIDIA can kind of do no wrong?
No.
Okay.
I have an admission to make. I was a small cap technology analyst at Franklin Templeton in the early 2000s. And I went to visit this struggling graphics processing unit company called NVIDIA. It was a small cap. And I came away thinking, not
How long ago was this?
20 years.
Okay.
And it was struggling back then because it was much more exposed to the PC cycle. There was a lot of competition. Likes of Intel were trying to get into combining CPUs and GPUs. Utterly wrong. Probably the worst decision I didn't make, in terms of an investor. But anyway, fast forward to today. The problem I have with NVIDIA is operational gearing. This is a business that used to make about 75% gross margins. So that means if you're selling something, you're making something that costs 10, you sell it for 40. In the newer products, the gross margins have gone to 90%, which doesn't sound like a huge jump. But that means if you're making it 10, you're selling it 100 now, and your profits have gone up, almost threefold. If they get back just to the historic gross margins, even if the sales continue, you'll see a real degradation in profits. So that operational gearing, in my mind, is completely lost on the market. The company can do no wrong. They're obviously in a great sweet spot in terms of demand. But I worry at some point that demand will just abate or even just normalise, and those gross margins could be under pressure. So in terms of answer your question, your position size, be mindful of that. This is a stock, if not priced for perfection, is certainly baking a lot of good news. It doesn't look that expensive on current price earnings, but look what it was earning 3 or 4 years ago. It might never go back there, but it might retrace some of that, and then would look quite an expensive
Would you take
stock.
some off the top then?
Absolutely. Great problem to have. So well done, but I would take some off the top and maybe even chance to rebuy it back at a lower price than it is today.
Keep the cash aside and put it in later. Got it. Okay. We are going to take another quick break. We're going to have a look at Martin's past picks when we come back. Welcome back. Time now to take a look at Martin's past picks from February 5th of 2025. At the time, he picked Saputo on the TSX, makers of cheese. It was 24.03, now at 27.17, up 13% for a total return of 15%. You were kind of chuckling at makers of cheese, but that's what I think of when I think of Saputo. Why do you like Saputo? Do you still hold it, and are you going to carry on holding it?
We've held Saputo for several years. We still own it. It's one of our core positions. I like cheese. I love cheese, probably too much. But why we like Saputo particularly is up here we think of those little red tubs. It's a retail business, but actually south of the border, which is its biggest market, where it's the number 3 dairy processor, it's more the food service side. It's a more commoditized market. It used to be very profitable for them, but we've seen real industry conditions depress things down there. So whilst it's still making good money here in Canada, it's also the market leader in the UK and Australia, number 2 in Argentina. The US is really dragging down its profitability. So very simplistically, if it gets back to half the sort of profitability it made in the US, it'll be a very cheap stock in aggregate. So there's a self-fix there. There's an industry fix that needs to be required. It'll take some time, but it could be a much more profitable business and look even cheaper than it is today.
What is dragging it down across the border?
It is, to pardon the pun, the milk-cheese spread. So milk is a very difficult market. Regulators, politicians like to get involved in milk. So when you have, too much milk, it can cause problems. You have too little milk, it can also cause problems. So there's a commoditized nature to this market, which I think was lost on investors maybe several years ago. It seems to be much more stable. They saw the depression that came through with the pandemic. The food service business shut down, and it's never really recovered. So we're still kind of working out of that problem there. So it will take some time to fix. But it doesn't need to get back to past profitability halfway, and we'll have a cheap stock in our hands.
Got it. All right, let's go to your next past pick, Smith and Nephew. At the time, so February of this year, it was 26.12 U.S. Now at U.S. 30.20, so 16% upside in that short period of time, 17% upside total return. They do medical devices?
That's right. So they do knee and hip implants. They do various products for advanced wound care, sports medicine, ENT, ear, nose and throat. Possibly the oldest company we own. It was founded in 1856 by Mr. Smith. 30 years later, it was joined by his nephew, Horatio Nelson Smith, great name, and we have Smith and Nephew. They were a dispensing chemist back then, but they're exposed to just the aging demographic, the heavier demographic. They are in a number of categories that have just long-term secular growth. They compete with the likes of Stryker, Zimmer Biomet, the DuPont division of Johnson & Johnson. And I just argue with Smith & Nephew, if it was in the US, it wouldn't be trading on the valuation multiples it is today. It'd be trading much higher because there's a discount for domicility almost for being in the UK. Okay. So it's on a big discount to Stryker, despite being almost as good a business.
But why this drop-off, sort of the fall of last year? Was there a specific event that triggered that?
They have had some difficulty in knees. We moved to a market called cementless knees. There was less cement in terms of getting your knees. They were a laggard in that, so they had to kind of play catch-up on their R&D. So there was also a change in management. So they've gone through a couple of issues, but the business doesn't really change all that much. So they now have a cementless knee. That product is up and running and selling. The management has been sorted out. So, again, it's not really something I worry too much about. These things happen in medical devices. You have bumps in the road, and so they seem to have overcome those quite well.
Did not know you had to put cement in the knees, but now I do. Let's go to your third pick from February, Electronic Arts, which is entertainment software, 130.47 US, now at 157.51, 21% upside for return and total return. Is this a company you still like, and what are they doing so well that in that short period of time they really have had a gain?
They were depressed, and so I think in some ways we've just seen the share price recover. And I never put too much validation in short-term price moves. Here we are, 4 or 5 months later, and the stock is up nicely. But it was just oversold, I believe, to some extent. The business hasn't really changed. They are the most utility-like of the video game companies. So they have a lot of sports franchises, in soccer, baseball, basketball, etc. They have like The Sims, which has been around for as long as I've been around, I think. And so there's not great kind of blockbuster games here like Call of Duty, but that's a good thing, I believe, not a bad thing, because it's not about the one-hit wonders. It's about just churning through the new series that comes every year, the microtransactions which make them, very, very profitable. My simplistic view with them is that at one point they'll probably disappear into the arms of another content company, like Activision Blizzard did with Microsoft. And the valuation that's paid for them is roughly 70–80% higher than you would pay than Electronic Arts is valued at today. So on an independent basis, a lot to like, but ultimately I think they probably disappear into someone who's going to build out their games platform like Netflix.
Is it a harder business to run because there's so much out there now in the sector?
Yes, I mean, they're a market leader. They have, of an industry, about $200 billion. Their sales are about $7.5 billion. So they have 3 or 4% market share. There's lots out there, particularly on the mobile side. And that's one area where they are relatively weak. They bought a couple of companies, Glue Mobile and Codemasters, to try and beef up that area. But they've been laggards in that. They're more on the console side, a little bit on the PC side. So they don't have Candy Crush, in their portfolio, which makes it kind of tough to get the eyeballs of the generations that are on their phone. But the console business isn't too bad.
Got it. All right. We are going to take a quick break. We're going to line up some more phone calls for Martin Cobb of Lorne Steinberg Wealth Management, taking your questions on U.S. and Canadian equities. Back in a moment. Welcome back. Let's go to the phone lines. Amin is on the line with a question. He's calling from Ottawa today. Hi, Amin.
Good afternoon. My question for Mr. Cox is, what is his view on Element Couche-Tard?
Okay, thank you for the question. Couche-Tard, of course, out of Quebec, but has been trying for some time to get some 7-Eleven stores, the Japanese owners and runners of those, into conversations about taking over. A lot of resistance at first. It seems to be moving, but we're not sure how much.
Yeah, and we're not particularly comfortable with that. We were long-term shareholders of Couche-Tard, and when they made the bid for Carrefour, that raised an eyebrow. We were concerned with that because that seemed to be outside their normal playbook. And now they've made a very big bid, for 7i Holdings in Japan. So we actually stepped away from the stock, having liked the business, having served us very well in terms of the returns we made. But we feel this deal could be one deal too many for them. It seems to be almost a legacy deal that they want to make. I've owned a number of companies in the past that have kind of small roll-up acquisitions, and then they made that one big acquisition, which was going to be game-changing. Yes, it was game-changing, but not in the way that we were hoping as investors.
Explain what you mean by that, too big of a deal.
Just the size. This would be, they'd have to issue a lot of equity, a lot of debt, and there'd be massive integration risks. I come from the UK. There was a bank called Royal Bank of Scotland, run by a Sir, a knighted individual, had a great acquisition strategy until it did ABN AMRO just before the global financial crisis and blew the whole bank up. I could give you, example after example of these great, these companies, this management have got a great sort of, history of acquiring businesses and rolling them up, and then they take on that last one because, maybe it's hubris, maybe it's not, but it's just too big for them. So this deal is just too big. So it's one we like if they end up walking away from 7i. We're happy to not be in the stock today. It's just the digestion and the execution risks of doing this deal are just too high. The risk reward is not attractive. But were they to walk away from 7i, we might be kind of interested in getting back in.
Got it. Okay, let's go back to the phone lines. Jerry has a question. He's calling from North Vancouver in BC. Hi, Jerry.
Good morning. Yes, my question is on McDonald's. Like all stocks, there's peaks and valleys, but this last move, it seems a little steeper and deeper than normal. Your thoughts? Would you be a buyer of the stock at this point? Thanks.
Okay, thank you for the question. Would McDonald's source more locally? Are they affected by tariffs?
They source locally pretty well. I mean, you see here the adverts in Canada, locally sourced beef. So I suspect that most of their ability to source internally, domestically, whether it be in the US, Canada, or other countries throughout the world, is quite high. So I wouldn't see them really as a beneficiary of tariffs or neither being hurt by tariffs. I've known McDonald's for years. I remember when it was an ex-growth hamburger joint trading on 10 times earnings because no one was going to eat burgers anymore because we're all going to become, was it Atkins diet, whatever diet was prevalent at the time.
No carbs or vegetarian,
etc.
Yes.
Now it's all about protein, so I have no idea. These fads come and go. It's an extremely well-run business. We like it. We've kept an eye on it. It's one we haven't bought yet. We were quite close to buying it during the pandemic. We kind of wrestle with it to some extent. It's just, it will serve you what you want. I mean, people, who cares? I mean, I love my Big Macs. I'll be honest about that. But they've been very good at just pivoting to whatever the customer wants. So it's never going to be great growth. I mean, their store portfolio now, both here in the US and internationally, it's not saturated, but it's, they're pretty much everywhere. And so there'll be some growth, but we just like the business, like the setup. The valuation just feels a little bit high for what is fairly pedestrian, but quite predictable growth.
But so many more burger places these days. The competition is really out there. And the way it used to be sort of your top three, and now every corner you go to has a different sort of independent burger chain on it.
Yeah, but if you're going for a burger, I mean, the burgers, I'll still go to McDonald's. Up the road from me, there's a couple of burger joints called Champ Burger and Super Burger, and then 5 minutes further along the road's the McDonald's. I just drive past them. But it's also, your kids. You've got your play areas, but the kids' food as well. The fillet-of-fish for my wife advert that used to be around. So it's more than just that. So, yes, the burgers are important. They've always had competition. I remember the times when Burger King or in the UK, Wimpy was going to take their lunch, so literally. And so I don't care too much about that. They will pivot, to what people want. The burger's still important. There's lots of competition, but that's never been any different.
Got it. Okay, let's go to the next caller, Keith, calling on the line from Brampton, Ontario. Hi, Keith.
Hello. Good afternoon. Taking my call. My question's on Molson Coors. I'll hang up and listen to your response. Thank you.
Thank you for the question. Let's have a look at Molson Coors and pull up that chart. Okay, so quite the drop off from the start of the year. not necessarily the April dip we've seen everywhere else. What's going on with this company?
I'm not a huge fan of the beer market.
Okay.
It's a bit like the wine market. I like my beers and I like my wine, but I'm not in any way sort of, party to this brand or that brand. I will move around. So, price promotion by other brewers, etc., is very tough. So the market is tough. It doesn't have great growth. I mean, the alcopops, as I would call it, or the hard ciders that came along, and the various flavoured drinks, etc., affected beer. We moved towards spirits at some point. So it's just a tough gig. They obviously have a great brand name. They're strong up here. But the growth is just pedestrian, and you are at the vagaries of competition. So when I'm looking at consumer-facing businesses, I'm looking for brands, looking for economic moats almost, but people want to go for a certain reason to buy a particular product. And I find with the beer market, it's just really hard.
Okay.
So I tend to avoid these stocks. They can look cheap, and obviously the stock is sold off, but long-term compounders and wealth generation doesn't tend to find itself in this industry.
Got it. Let's go to another caller. Tim's on the line. He's calling from Montreal. Hi, Tim.
Hi, I'd like to have your opinion on Chevron, please. Thank you very much.
Okay, thank you for the question. Let's take a look at Chevron. Is this something you've owned or looked at before, Chevron?
Yes, I used to be an oil and gas analyst. I ran the oil and gas team at Templeton, so I've looked at Chevron many a times. And what you get with Chevron is you get a bit of both, because you get upstream and you get the midstream and downstream. So you get refining thrown in there. So maybe I'm just getting old and want my life easier, but I'd rather have either an upstream player like an Occidental, because then you basically have an expression on the oil price, or have a refining or a midstream business, midstream particularly pipelines, which are just much more dependable. With Chevron, you get a bit of both, and so you might do quite well on the oil price side, but then you lose money on the refining side. And refining is a very tough industry. There was a golden period for it when the refining margins are very high, but it tends to be a pretty cyclical business. And so I don't tend to like that, So I would say Chevron, not too bad, well-run company, but, maybe look at like an Occidental or an Exxon, or up here, a Canadian Natural Resources, which we like much more, so because you have an expression then of the oil price in your portfolio, and you don't have to worry about the vagaries of refining.
But just how do you feel about oil moving forward? I mean, everybody's in a big energy push right now. Oil's going to get caught up in some of that, but then again, we saw geopolitical events that are taking it down. So how do you feel about oil moving forward?
I wrote a white paper on trying to predict the oil price many moons ago, and basically came up with a conclusion: just look at the forward curve. It's the best predictor, because we used to look at a number of factors, production versus demand, inventories, all this sort of stuff, and it ended up being short-term noise. I remember people sitting here a couple of years ago talking about China reopening after COVID. It was going to lead to huge demand. OPEC was going to tighten up. We just don't know. So in the short term, nobody has a clue about the oil price. So what we do is, rather than trying to predict the oil price, is find low-cost producers. Canadian Natural Resources, when WTI averaged 39, still was free cash flow positive going back in 2022. That, to me, is what matters. So if the oil price is to be very strong, they will not do as well as some of the higher cost producers. If the oil price is low, they will do much better than some of the higher cost producers. So rather than trying to predict the oil price, which we all want to do because we like to predict, just buy low cost, high quality producers.
Got it. Okay, we're going to take another break and line up some more phone calls from Martin Cobb. We're back in a moment. Welcome back to Market Call. Let's go to John on the line from Ottawa today with a question. Hi, John.
Hi. Thank you for taking my call. I've been a long-time investor in the TD Bank, and they had a blunder in the U.S. Last year. But I noticed on its graph over the last 6 months, it's been moving up pretty much almost every day. Rarely have I seen in the last 6 months it hasn't moved up, which is great. And I'm wondering how much more is it going to continue moving up? It's still paying a 4.25% dividend return, which is very healthy. And I'm just wondering, what's your target in the next 6 months? My concern, and I'm sure this is on the back of everyone's mind, is the housing market in Canada, particularly Toronto. And just want to get your opinion on moving forward on the TD Bank in the next 6 to 8 months or a year from now. Thank you.
Thanks for the question. So a lot to unpack there. First of all, yes, the blunder all of last year, let's say they paid that penalty out and had to come back from that. And then factor in housing, right? Toronto, the biggest market in the country. Things have kind of stalled here. The question is, how much longer is it going to stay stalled? And what do the banks do as a result?
Yeah. The banking sector in Canada is really interesting. When we launched a Canadian dividend strategy, I anonymised the data and sent it to Lorne for him to have a look at and tell me which is the best bank, and then rank them 1 to 5. And RBC came out as number 1. TD and CIBC probably shared number 2. So we've liked CIBC. It's been one of our largest holdings. And I would say in the last several months, we've kind of flipped somewhat to TD because of, just the pessimism surrounding what happened in the US. They're going to have to work through that. It's going to take some time. But the discount it was trading to RBC,
sure,
and even a discount to CIBC, which has been by far the best performer, was excessive. I don't have 6-month price targets. I have no idea what's going to happen to the market in the next 6 months. But having a longer-term view, we're talking multiple years, TD will sort out the problems it has in the US, has a very strong franchise up here, obviously, in Canada. I don't worry about the housing market just because the insurance that you have in place, the provisions that you've seen them take on the performing side of the book, I think are very conservative. Yes, there'll be continued provisions and write-downs, etc., going forward, but they're very well positioned. TD to trading sub 1.5 times book value. RBC, better bank, but maybe not worth the 2 times book value plus that's trading on today. That gap will probably narrow to somewhat. Maybe RBC will come down a little bit, but I think TD will continue to make good returns on equity, and drive the business forward, regardless of what happens the next year or two with the slowdown here.
Got it. Okay, let's go back to the phone line. Simon is on the line from Calgary. Hi, Simon.
Hi, good afternoon. My question is about Tesla. Any future comment, please?
Okay, thank you for the question. I haven't looked at Tesla in a couple of days, so let's have it up here. It's at 327.75, still lagging the others as far as a comeback goes, but again, a lot of problems there.
Yeah, Tesla, it makes me smile because I believe if you would buy Tesla today or own Tesla today, you have to believe not only is it going to be a super profitable car company, it's going to crack robo-taxis, driverless cars, energy storage, and all of the above, given just the valuation ascribed to that. A car company, a good car company, might make between 5 and 10% operating margins, which is kind of where they are today. But in addition to that, you have this, discussion over the robo-taxis, whether or not they've got better technology than Waymo, etc. The best EVs in the world today, I believe, are Chinese, BYDs, etc. And they're making them at prices that you wouldn't believe if we didn't have tariffs on them. I would buy a BYD. So this is car manufacturing. It's not an easy gig. It's really tough. And I personally don't believe that Tesla is going to crack all those other markets and be very profitable in them. So I would just say major health warning attached to owning Tesla today. The risk reward is not in your favor. The probabilities are against you.
Got it. Let's go to the phone line. Valentina's on the line from Burlington, Ontario. Hi, what's your question today?
Hello, hi. I'm getting close to retirement, and I'm looking for dividend stocks, and Royal Bank is one of them. I'm looking for something that will beat the inflation by about, let's say, 3-4%. So looking maybe for annual growth of combined growth plus dividend, maybe 7-8% range. Does Royal Bank qualify?
Let's, Royal Bank, we were just talking about, you said it's up to 177 today. It's a good dividend stock, but do you see some growth here, or is it going to kind of stay, you think, where it is? It's a pretty high value at this point.
Yeah, just backing out the kind of thinking, your dividend today, I think, is about 3.5%, so it's not as high as it once was, obviously, based on the share price. RBC makes about a 15% return on equity, 16%, retains about half of that and reinvests in the business. So if it can continue to do that, it should be able to grow the bottom line at mid to high single digits, plus the dividend, that would give you closer to 10%. The only problem I'd have on that is the valuation ascribed to it today is up there. It's above its historic averages, whereas TD is below its historic averages, as we were talking about. So whilst you might get 7, 8, 9% on the underlying basis, you might lose 1 or 2% on the valuation compression over time. That would satisfy, the 7-8% target, which I think is a sensible, healthy target, certainly. But I do believe there are better opportunities in the sector. TD, I think we would have slight preference over RBC today. And then there's some other dividend-paying stocks you could certainly buy. We mentioned Canadian Natural Resources as one of them. So we like RBC. We have a holding in it. Our marginal dollars are going probably elsewhere within the sector.
Got it. Okay, let's get to one last caller. Jerry is calling from Toronto. Hi, Jerry. What's your question?
Yeah, hi. Thanks for taking my call. My question's about Magna. I've actually owned Magna for probably 15 years or more, and it did really, really well for many years, but it's really not done well at all. I was just wondering what your opinion is from a valuation point of view. Should I just give up on it and look elsewhere, or do you think there's still a lot of good value there?
Okay, Magna, of course, would be affected by the tariffs and what's going on with auto sales. It has dropped down to $51.99 to $52. What do you think?
Yeah, we own Magna. We've owned it for some time. It will be affected by tariffs, obviously just slow down auto production, but it has 400 plants around the world embedded within, the OEMs, the GMs of this world, the BMWs. So it will be affected. It's bringing in products, etc. itself, but it's not crossing borders in terms of its actual sales to its customers. If you look at Magna, historically, it's a cyclical business, but they've earned a 6% operating margin, 5 to 6% operating margin over time. Sometimes it's 7 or 8. Sometimes it's 2 or 3. They historically make positive margins. It's not that bad a business. If they get back to a 6% operating margin, on today's sales, the stock is on something like 5 or 6 times earnings. So I wouldn't necessarily have it for 15 years, but I do believe there will be a better buying opportunity. At some point, the cycle will turn. Investors, as they do, will extrapolate the increase in profitability, and the multiple will pick up, and you will be served quite well. So we own Magna. It may not be one we own in 5 years' time. At some point, there may well be a much better buying opportunity if history repeats itself, which invariably does.
Got it. Okay, we're going to take a quick break. When we come back, Martin's new top picks. Back in a moment. Welcome back. Time now for Martin's new top picks. We're going to begin with Adobe on the NASDAQ. Adobe, when we think about it, I think of it as sort of the creative work that we do online. But now there are so many other competitors. Does Adobe still sort of stand out in that class, or not really?
Today it does, but the fear is it won't, and that's why I think it looks particularly interesting. We were talking about Dollarama earlier. Dollarama and Adobe both came out with earnings on the same day. And talk about glass half full and glass half empty. Dollarama came out with good earnings and reaffirmed its full-year guidance, and the stock was up almost 10%. Adobe came out with good earnings and upped its full-year guidance, and the stock fell 5%. This is a business that investors, I wouldn't say loathe, but certainly seem to dislike. The great fear is over the competitive threats. What does Adobe do? It does, Illustrator, Photoshop, etc. My wife uses it. My daughter uses it. There's the Acrobat document stuff that I use. It also does quite a lot of CRM software, customer relation software, and data analytics. So it does a lot of things. But the Creative Cloud is what front and center with just investors today. They're worried that OpenAI, image generation, etc., is going to take away its lunch, or certainly be much more competitive. We had the same fears about Acrobat 20 years ago, that was going to be competed away by Google Docs and all the other things today. To me, the valuation has just collapsed. So they're still likely to grow double-digit this year in terms of earnings per share growth. Consensus is still looking at 14-15% earnings per share growth over the next 3 years. But it used to trade on a 32 times average multiple the last decade, forward-looking multiple. Today it's on 17. Because of this fear over monetization of AI and their inability to demonstrate it yet, as they weren't able to do with Acrobat, etc. So there is more competition. There's more ability for me to be creative, certainly, but ultimately they are spending 18% of sales in R&D. They will have something that will be very compelling. They have 40 million Creative Cloud subscribers, adding 10,000 a day. I think that one of the cheapest stocks that we have in our portfolio.
Yeah, I saw your note that it was 10,000 a day, and I was like, wow, that's an impressive number. Okay, let's move on to Diageo in New York. They do spirits. What do you like about them moving forward?
They are the world's largest spirits producer. Have some great global giants, Johnny Walker whiskey, Smirnoff, Baileys. They have Guinness beer, etc. They had a great pandemic as we all sat at home, probably drinking a bit too much. They've had a bit of a hangover. So sales have typically grown 3, 4, 5% organically every year. They grew by a third over the 2 years. And so we've seen a couple of years of flat growth. Now everyone is worried about Gen Zs not drinking, etc., that people are trading down. But this is a premiumization strategy in the West in terms of pushing the price points, and a volume growth strategy in the rest of the world, developing world. 19 of the top 20 liquor brands selling today, last I heard, were around 100 years ago. So despite all the fads and all the fashions, liquor brands have great longevity, and this is the stock to own in the sector.
Got it. Okay, I do want to get to your last pick, which is Visa, which has been on a number of people's lists, Visa and or MasterCard, but you like Visa. Why?
Visa is possibly the highest quality business we own in the portfolio, 97% gross margins, 60% operating margins. It's not a bank. People think it's a credit card company. They take a slither of the 2.5% interchange fee that merchants give up when we use our credit cards. is a play on global volumes, global transactions, global nominal GDP growth, etc. And there really is no option other than them or MasterCard. There are worries about stable coins. There were worries previously about PayPal, etc. coming. This is just a technology provider. However we decide to pay for something, Visa, MasterCard will take their fair share of it.
So you don't worry about other digital payment methods sort of creeping in on their space?
They are able to handle 250 billion transactions a year in an average approval time of a few hundred milliseconds. So take PayPal as a great example. PayPal was going to be what did PayPal end up doing? It ended up sitting above the rails, sitting on top of the Visa and MasterCard networks. These are networks that are all over the world, the acceptance of merchants, etc. There'll always be threats, and they're investing in stablecoin companies. They're playing around with some of these types of transactions, digital payments from a number of the companies like Stripe and Plaid, etc. But I believe that the very fancy telecoms network cannot be replicated and will continue to provide the backbone of credit card transactions for some time to come.
Got it. All right, got to leave it there. Martin Cobb, thanks very much for coming in. And thank you for watching us today on Market Call. We'll see you again tomorrow. Look at the markets as we head to break.